Okay, welcome everyone. Thank you for joining our webinar today on regulatory changes in corporate landscape in the EMEA region. My name is Rosy Lopez and I'm a senior industry consultant for global operations at Athennian. And I'm excited today to host this webinar along with our special guest, Daniel Steigert. Daniel is Director of Global Business Development at International Business Company Formation, Inc., also known as IBCF, one of the key partners here at Athennian. So Daniel, if you can please introduce yourself further and talk us about IBCF.
Sure. Good morning, everyone. Thanks for joining today, and thanks for having me as a guest here. So excited to speak about the regulatory changes and corporate landscape in this region. As Rosy mentioned, I am the Director of Business Development here at IBCF, International Business Company Formation, and I've been in this role for about 13 years now. Quite extensive experience doing international formations, governance filings, compliance matters, and really excited to get through this presentation today. And a lot of you may already work in this industry and know a lot about it. So if you can take home something new or just one thing today that is interesting, I really hope you can. So Rosy, happy to be here and happy to get into this webinar here.
Thank you, Daniel. Thank you for joining us. I'm going to do a quick overview of our agenda points today. So this is what we're going to be covering: an overview of our corporate and business landscape in the EMEA region. We're going to go over some key current and upcoming legislations. And at the end, we're going to share some best practices for navigating regulatory changes. And before we start, I just wanted to share some key information. The recording of this webinar is going to be available soon, a few hours after the webinar ends. It's going to be shared in a link by email with all the attendees and people that registered to the webinar. Please share your questions or comments with us in the chat box. We're going to have a Q&A session at the end. And also as a bonus, today, after the webinar, we're going to be sharing a guidebook. It's called the Beneficial Ownership Guidebook. And again, it's going to be on the email that's going to be shared with everyone with a link after the webinar. Okay, so let's start with an overview of the corporate and business landscape, starting with Europe. Daniel will walk us through the most common entity types and advantages. So start when you want, Daniel.
Sure, absolutely. So so there's numerous entity types throughout Europe. And the first thing I want to say about this entire webinar is the EMEA region is a very large region with a lot going on. So everything that we do go over today is a 30,000 foot overview. So there's it's going to be very general, and we'll try to get into some specifics, but here we go. So some of the more common entity types we'll have throughout Europe are the limited liability companies, which I'll touch on in a second, corporations, private and public companies, partnerships, and a few other entity structures. So you might be thinking LLCs, that's a term I've only seen in the United States, and you generally are correct. The concept of limited liability companies are known throughout the world. However, there are different names to them and slightly different definitions of them as well. So the first one we're going to start on in Europe is the equivalence of limited liability companies. If you see corporate structures with the corporate indicia SRL, such as in Belgium, APS, such as in Denmark, SARL in France, or GmbH in Germany, that's an indication that it is a limited liability company. Now, what I will say is I'm not fluent in a lot of foreign languages, and I will try to pronounce some of these. So forgive me if I mispronounce them, but the SARL in France, the Société à Responsabilité Limitée, and in Belgium, the SRL, similar, Société à Responsabilité Limitée, and Germany, the GmbH, the Gesellschaft mit Beschränkter Haftung. It is a lot to say, but those are the indications of the rough equivalents of what we know as limited liability companies. So these structures, the owners of these structures are not personally liable for the company's debts, and in most cases, it's legal actions. All right. The other thing I want to point out is that these companies are usually smaller enterprises. So think of your more regional businesses, entrepreneurs, kind of businesses like that. Now, the next one is corporations. And the main thing I do want to point on is that the definition of a corporation, it's going to vary by each EU country. And these structures are generally used by larger enterprises, okay? So these are generally referred to, or sometimes I should say referred to, as joint stock companies, company limited by shares, or private companies limited by shares. All right. These structures separate the company's debts from the owners and can allow for more shareholders, which is why larger enterprises choose to go with them. And one of the reasons companies will generally go for corporations or one of these structures is because they're going to be listed publicly. The other thing with these structures, a lot of them will have paid-in capital requirements. So Ireland and Lithuania are examples of this. And some of the examples you'll see throughout Europe, the corporate indicia of these, you'll see a DD in Croatia, an SAS in France, an AG in Germany, or an LTD in Ireland, for example. So similar to what you would see in the United States or maybe throughout Canada. I'm not going to try to pronounce some of these because they are outside of my scope of translations, but those are the indicias that you can look for. And one of the other main common entity types throughout Europe is partnerships, right? So these present certain advantages both for liability protection and tax purposes, all right? And there are different partnership structures throughout Europe. There's limited partnerships, general partnerships, and limited liability partnerships. Greece and Hungary, for example, they offer general partnerships in which the partners have unlimited liability for the company's debts and obligations, and it is managed by one or more managing partners. Hungary also offers a limited partnership in which at least one partner has unlimited liability for the company's debts and obligations, while the other partners have limited liability and is managed by one or more managing partners. Ireland, for example, I mentioned the limited liability partnership. This is a jurisdiction that does offer that. And this is a partnership in which the liability of the partners is limited to the value of their contribution to the partnership, which is different from an Irish partnership in which the business owned and operated by two or more individuals who are jointly and severely liable for the debts and obligations of the business. So those are the main entity types. I know we only have an hour here today, and we could probably do another hour presentation on just these alone. So I'm trying to give you the quick hitting points of these. And then some of the other entity structures you'll see throughout Europe are branch offices, which are essentially foreign qualifications of other entities, nonprofits and cooperatives, Societas Europaea, or what is now known as a European company, this is a fairly new structure. This is a public limited company that operates under the legal framework of the European Union, so not a specific country. And this was introduced in 2004 to help companies operate across the EU without being bound by the laws of the individual countries. So those are your main structures and some quick hitting points about each one.
And Daniel, how do you see some statistics on new registrations? How are new businesses growing in the European region? Can you share some more information about that? About what are the trends in terms of number of investors coming to the region recently?
Sure. So throughout the EU, this is through research. I mean, our company, we've seen, I don't want to say an influx of European registrations. It's been kind of even and status quo over the past couple of years. But generally speaking, the EU shows no clear pattern of business registrations quarter over quarter. So it's kind of up and down. And you know, I don't know if COVID has played a part into that, or new regulations, or some tax matters throughout the countries. But the number of new business registrations in the EU has seen a number of fluctuations since 2018. And that was after a slight increase. And then 2018 saw a slight increase into 2019. And then in 2020, there was a significant drop for obvious reasons, right? And then in the third quarter of 2020, registrations started to trend upward again. And they've been trending in an upward direction, but kind of have been hitting a plateau. And then the first quarter of 2024 saw the highest level of registrations since pre-COVID. So, but it's kind of evened out a little bit now.
That's great. Thank you. Very interesting. So now I'd like to walk you through a high-level overview of the complexity across different countries in Europe. And Southern Europe in particular stands out as one of the most complex regions for doing business in Europe. And this is due to the diverse regulatory frameworks, frequent legislative changes that are very local focused and not harmonized with international standards, and also unique compliance requirements are what make it challenging for companies to operate smoothly. And the most complex jurisdictions in the region are not only Southern Europe, but in Europe in general, are France and Greece. And many can see France as an attractive market and a stable business hub. It attracts talent from across Europe. It's a country or jurisdiction supported by European Union regulation, its role also as being the OECD headquarters. However, they have very unique accounting standards, for example, French language requirements and strict labor laws, along with recent 2024 regulations around UBO identification and tax laws reforms also have increased compliance cost and complexity in France. But it's really Greece, the most complex country in Europe. It's particularly complex due to frequent legislative changes. In the past year, there were new regulations introduced every week, almost every week. They had a new law coming up. So they are also doing some efforts for digitalization, but instead of helping, for example, they have a new platform called My Data. It's an accounting platform, and it requires multiple data submissions and multiple new deadlines. So instead of helping, it's making the procedures more complex. These challenges often lead to investors to seek, for example, third-party support for specialized local accounting, tax, payroll services, and that this increases the operational cost of doing business in Greece. On the flip side, Northern Western Europe have some of the least complex jurisdictions due to their regulatory stability, high levels of digitalization, good digitalization, easy to use, and streamlined compliance processes. And Denmark leads in simplicity. They have a fully digitized tax processes. It makes it easier to set up and operate businesses with very minimal regulatory friction. UK, despite recent changes due to Brexit, continues to offer a stable regulatory environment with one of the simplest tax systems in the world. And its commitment to digital infrastructure supports businesses in meeting their compliance obligations efficiently. And recently, the company's house has introduced new requirements that are intended to clean up the data and to make the annual reports and all the reporting easier in the long run. Something interesting to mention for Europe is that the Channel Islands are now considered a very interesting business hub in the region, particularly Jersey and Guernsey. which have become strategic hubs for global businesses due to their robust regulatory frameworks and tax-efficient environments, while Guernsey regulatory requirements are expected to become more complex in the next few years. Both islands remain attractive for businesses seeking a stable and well-understood regulatory framework. So now let's move on to the Middle East. Daniel, please give us an overview of the different and most common entity types in the region.
Sure. So the first thing I want to talk about is free trade zones. And that's specific to the UAE. And the free trade zones, that is not an entity type or structure. And I'll talk about that in a minute. But the UAE, it seems to be leading the way in the Middle East in terms of corporate. And a lot of companies are looking to go there. A lot of foreign individuals are looking to go there. And that segues me into what a free trade zone is. And if I say FTZ, that's just the acronym for free trade zone. So these are designated areas where companies can operate with specific benefits and exemptions from certain regulations that apply in the mainland UAE. So these there's over 50 free trade zones in the UAE, and they're strategically located near ports and borders, and I'll get into the reasons why in a second. But one of the first reasons these free trade zones are becoming increasingly popular it allows for 100% foreign ownership. So unlike mainland UAE entities, where foreign ownership is often capped at a certain amount, companies in free trade zones can be wholly owned by foreign investors without the need for a local sponsor or partner. So you can operate as a foreign individual and own the company 100%. There are tax incentives for free trade zone companies, including exemptions from corporate tax, import and export duties, and personal income tax. These exemptions are typically granted for a specific period of time, but they're often renewable. They're simplified processes for corporate formations. They're generally quicker and more straightforward. And again, this is because they want to attract more foreign investment. And many free trade zones do not require a minimum share capital to establish the company, which can be very beneficial and very attractive for foreign investment, right? So the other benefit are customs and trade benefits, where goods imported into a free trade zone are generally exempt from customs duties. Companies can re-export goods without incurring custom duties, making these free trade zones ideal. And again, I mentioned that these zones are near ports, airports, borders, major highways to allow for this, right? There's a lot of operational flexibility. Free trade zones cater to various industries, including trade, manufacturing, logistics, professional services, and each zone may have specific sectors that it specializes in, right? Media, finance, technology are some examples of that. And then in terms of employment, these free trade zones have more flexibility in hiring foreign employees as well. So not just owners and investors, but foreign employees. So they can issue work visas without restrictions on nationalities or quotas that may apply to mainland UAE entities. And then just two more quick things about the legal framework. Each free trade zone operates under its own regulatory authority and legal framework. These zones have their own laws and regulations concerning activities, licensing, and dispute resolution, which again could be very attractive to foreign investors. And these trade zones generally don't require a UAE national to act as a local sponsor, which I mentioned before. And then one of the things that makes it really attractive is that these companies in these trade zones can operate in any currency, so not just the local currency. And there's no restrictions on repatriation or profits or capital. So those are, a free trade zone or something like that might be something you hear quite often nowadays. And that's kind of the high level overview of what free trade zones are. So the most common ones that you'll probably run into are the Dubai Multi Commodity Center, the DMCC, Jebel Ali Free Zone, JABZA, Dubai Internet City, Abu Dhabi Global Market, the ADGM, or the RAK Free Trade Zone. So again, that is it's becoming increasingly popular year after year to go into these free trade zones. So I felt it was important to really dive into that a little bit more. And then the entity structures, right? There are free trade zone companies, which are referred to as FCZs. And these companies they conduct business inside the defined free trade zone. And again, there's 0% personal tax, no hiring restrictions, 100% exemption from import and export duties, and access to other international markets. There are limited liability companies throughout the Middle East, and these could be established by 2 or more shareholders with a maximum of 50% shares, who are each only liable for their individual shares of the company's capital. This means the personal assets of the owners or shareholders normally cannot be used to meet such responsibility if the company incurs difficulties or faces legal issues. Some other common structures that you're going to find throughout the Middle East region are joint stock companies, whether they're public or private. These are usually owned by non-governmental organizations. The shares cannot be offered to the public if it's a private entity. If it's a public, then it can. A public joint stock company in Dubai, for example, must have a minimum capital of 2 million, I believe it's dirham, if I'm not mistaken. I could be wrong, but the local currency. A private shareholder business must go by the same rules as public shareholding corporation. And I could go on and on. And some other benefits are the management should be delegated to a board of directors with a minimum of 3, a maximum of 15 members. So there are some caps there. Local businesses who tend to engage in banking, finance, or insurance must typically be run as these structures, whereas foreign businesses engaged in similar operations may open branches or representative offices. And one of these examples are in Dubai. And then the other entity structures that you're going to see in this region are branch offices, as I just mentioned, partnerships, sole proprietorships. But those are the main ones that you're going to see, and the joint stock companies seem to be the top in the region, followed by those free zone companies.
Thank you, Dan. Based on your work at IBCF, have you seen any trends? Have you worked recently with companies opening in the Middle East in general, but specifically in any of the free zones in UAE?
So from my experience here, we do a lot of work in the free trade zones, working with a lot of international clients who want to have a presence in the UAE. They'll look to open a free zone company, and that's been a very upward trend for our business, working with new formations in one of the free trade zone companies. And I do have to say it is a fairly easy process to get through that.
Great, thanks. So now I'm going to go on the business landscape side. And the Middle East in general ranks pretty high in complexity compared to Europe, particularly due to frequent changes in tax laws, inflation, and also due to unique regulatory requirements. Again, this is one of the main drivers of complexity, is when they have very local focused legislation and their legislation is not harmonized, meaning more aligned with international standards. And at the top of the list of the most complex at the moment is Turkey. Businesses in Turkey face high complexity due to these frequent changes in tax laws in particular. Recent additions like a recycling contribution fee on imports, for example, have further complicated tax reporting, hyperinflation, it's also a key factor. It raises compliance risk. And while they have good intentions in trying to attract more business, for example, they have VAT incentives and exemptions. These have been introduced recently to aid the production sector. However, there's a lot of bureaucracy. This often discourages companies from utilizing these incentives. Additionally, the requirement for all documents to be in Turkish poses, of course, challenges for business without a Turkish-speaking employee or representative. And this adds layers of complexity to an already challenging regulatory environment. And on the other side, for the least complex countries, Saudi is there. They're trying to compete with UAE in trying to become easier. Businesses in Saudi Arabia face challenges still with, they're trying to transition to an e-invoicing system. They're trying to automate a lot of processes, but there's limited information on these new processes. Also, there's the compliance of what they call the Saudization rules. And this requires a percentage of local employees. So all companies must have some local employees. That's mandatory. And of course, these add some complexity and operational risk for foreign investors. Despite these hurdles and issues, once you understand the system, you can adapt to it. And then this leads to smooth operation. They have an ambitious plan called Vision 2030 that Daniel is going to talk about that later in the presentation. This is driving diversification into non-oil sectors. They want to attract other sectors like tourism, renewable energy, healthcare, technology like AI, digital infrastructure to the country. So this is making Saudi Arabia to grow rapidly, and it is up there competing with UAE. And of course, UAE is the least complex of the jurisdictions in the region. Like Daniel explained, they have all these free zones, which also adds a layer of complexity because all these free trade zones have different legislation and rules. And they also have different specialties. So for example, there are some regions that are more designed or have rules to attract oil industry. There are other ones that are more attracted for tech companies, like the DMCC, for example. I had the opportunity to open in my past role a company in the DMCC. And the main blocker really was that they rely a lot in their real estate business. So one of the requirements was to, depending on the amount of employees, they require a certain amount of square feet per employee that you have to rent an office space for that, even if it's a remote company. So, but that's something that they're trying to move away from. UAE is, of course, also the business hub in the region. Its location makes UAE the perfect hub for trade, especially between Africa and Asia. They offer various visa structures for people, zero income tax. Generally, they have a really high standard of living, and this attracts a lot of foreign investors, but also it's a great talent pool for companies to hire in the country. And yeah, this makes UAE, again, a very attractive business hub in the Middle East. Let's talk about Africa now. Yes, Daniel.
And can we just go back to the Middle East and just talk about statistics for a few minutes? And this is something I find very interesting, right? Because Turkey is one of the more complex countries in the Middle East for company registration and corporate governance, right? However, I think one of the more interesting things that is in the past calendar year, Turkey has led the Middle East in terms of business registration. So in the past calendar year, they've registered over 100,000 companies. The next country in line was 20,000 companies, and that was the UAE. And then Israel had registered 17,000 companies, and Saudi Arabia right behind them at 16,000 companies. So that is an interesting correlation, if you will, that although they are one of the more complex countries in the region, and one can make an argument for the world, that they're still leading in terms of registrations. And I have a few thoughts about that, which I'll just go into really quick. I think it's a great strategic geographical location, right? It serves as a bridge between Europe and Asia and really the entire Middle East, right? It's combined, it has a pretty business-friendly environment, a very large domestic market, as well as an international market that they can go towards. They have a young and educated workforce, affordable labor, government incentives, and it's really a prime hub for regional trade and expansion as well as international. And I was just there back in July, and it's also a very beautiful country. So there's definitely a lot to offer. And then also in the Middle East, Israel, for example, they're known as a startup country, right? That's one of the nicknames they have. They really have a culture and environment to be entrepreneurial and innovative. And I actually did an executive leadership program in Israel last year to learn all about this culture and innovation and entrepreneurship that they really push. So the government in Israel, for example, they provide a lot of incentives to promote innovation and startups. They have startup funds, they have grants for research and development, and definitely a lot of tax incentives for startups. So it definitely is a unique culture there in terms of innovation and entrepreneurship. So but very interesting statistics for the region.
Yeah. And thank you for sharing that, Daniel, because when we share this information, we're not trying to scare anybody about whether to go to a particular jurisdiction over the other one. This is exactly for informational purposes. So they take this information into consideration when considering opening businesses in these very strategic regions or in very strategic countries, even though they can be more complex. When you know about the complexities, you can plan for these complexities. You can take these into consideration for your budget, for your timeline. But yeah, these are very strategic countries. And yeah, companies should still plan to have a successful new market expansion or operation in these businesses. The more you know, the better you can operate in the region. So let's go to Africa now, Daniel.
Sure, absolutely. And it's a beautiful picture you have on the screen. I was there actually for New Year's, and it's, again, a beautiful country, the soccer stadium, Table Mountain in the back there. And South Africa is one of the leading countries in terms of corporate registrations, the ease of registrations, and corporate governance for that matter. So a lot of the common entity types that you'll find throughout Africa, right? And Africa is a very large country, a continent, I should say, with a lot of countries. And the most common entity types that we're going to find throughout Africa are partnerships, private limited companies, and public limited companies, right? So partnerships, you have two types: general partnerships, limited partnerships. You're generally going to find these in Kenya, Ghana, South Africa, and Nigeria. Some of the advantages, shared responsibilities, and the skill of laborers, their knowledge, right, of the partners, I should say, sorry. And some of the disadvantages are that partners are personally liable for business debts unless it's a limited partnership. So those are the two types of partnerships that you're going to get throughout Africa. You have private limited companies. The corporate indicia of that's going to be LTD for the most part. And this is a company that limits the liability of its shareholders to the amount they invested. And it cannot offer shares to the public. So it's not going to be a publicly traded company. Some of the countries you'll see this in are Ethiopia, Ghana, Kenya, Nigeria, and again, South Africa. Again, one of the advantages, it has limited liability for its shareholders, and a disadvantage of it, is there's going to be more compliance and administrative requirements than some of the other entity structures that you're going to find. And then really the public limited company, that's generally going to be more for, again, like Europe, the larger enterprises that are going to use this, companies that are going to be listed publicly. And again, the advantage of this is that you can raise capital through public investment. And then some of the other entity structures that you're going to find throughout the continent and the region, they're going to be NGOs, non-governmental organizations, branch offices. So if there's a Dutch company that wants to do business in South Africa, they can register a branch office down there. So it's just an extension of that company. You'll have joint ventures, cooperatives, state-owned enterprises, and special economic zone entities.
And Daniel, have you worked with companies recently opening, incorporating in Africa?
So Africa, it hasn't been one of the more popular jurisdictions. So we'll do some work. A lot of it's more in South Africa, some in Ghana, a little bit in Nigeria. Those seem to be the three bigger countries that we work in within Africa. We'll do a lot of transactional work in Egypt, but in terms of formations and corporate governance, it's a lot of South Africa, Ghana, and Nigeria that we do work in. So, and it's mainly private limited companies that from our experience and my experience personally, that we're dealing with.
Is there a particular industry that would like to go into these countries, or
it seems technology, that they're trying to advance themselves with a lot of new technology and investments in technology. And that's just, and I'll be honest, that's from my experience here at IBCF working with private limited companies that are being formed there, and from being in South Africa at the beginning of the year. It seems there is more of a push to get brought up to speed with technology. So a lot of technology companies are looking to go there and have a presence there.
That's great. It makes sense. And in terms of the business complexity in Africa, it varies from country to country. Each country will present their unique challenges, but also opportunities for foreign investors. And like Daniel said, South Africa stands out as the least complex country in the region. They offer a relatively stable regulatory environment, established business structure. It's well-developed financial sector, clear tax regulations, and accessible corporate governance frameworks make it very attractive for international business from different sectors across different industries. However, compliance costs can be high in South Africa, and navigating local labor laws in particular require careful planning. This may mean that you will need local support. Nigeria is one of the most complex countries for business in Africa. They present significant challenges, including frequent changes in tax. And again, this is like a common factor that we see. The more the tax laws changes, the more complex is to navigate business in these countries. Complex import and export procedures also make Nigeria a more complex country to operate in the region. This country has also a very volatile economic and political environment. They have high inflation and foreign exchange restrictions. These are all things that add to the difficulty of operating in Nigeria. Navigating local regulatory landscape and ensuring compliance with varying state-level requirements, not only at the country level, but state-level requirements also demand local expertise that can increase operational cost. Something that I'd like to highlight is that a business hub that's standing out in the region is Kenya. Nairobi is positioning or is positioned as a regional tech and innovation hub recently, and this has attracted a lot of multinational investment. But understanding the local market dynamics and regulatory requirements is also essential for smooth operations. So that makes sense with what you said, Daniel, that these countries are looking into developing their own business hubs to attract more technology that will also translate into more business, more employment, and more advancement to the region. So now let's change to talk and highlight some key regulatory changes and new legislations in the region, in the EMEA region. Let's talk about UBO and anti-money laundering requirements in these regions, Daniel. If you can walk us through these, that would be great.
Sure, absolutely. And I know we got about 20 minutes left and there's a lot of information, so I'll try to get to the quick and dirty of this. So in Europe, right, they, in my opinion, and it can be argued that the EU and Europe kind of leads the way in terms of UBO registrations and requirements. But currently, all EU member nations have a UBO requirement, and it might be its own UBO register or some level of reporting requirement. So nations such as France, Bulgaria, Luxembourg, Latvia, and a handful of others provide access to their registers free of charge for any type of use. So anyone could go on and find out who the UBOs are. Belgium, Ireland, Romania, Sweden, Netherlands, they provide access, but it is for a fee. And countries like Portugal and Croatia, for example, only provide access to its citizens or other EU citizens. So me here in the US, I would not be able to access UBO registers in Portugal and Croatia. But the reporting requirements and data needed are pretty similar across the EU. So, you know, names, addresses, you know, could have source of funds that need to be put in. So, but the EU is again, in my opinion, leading the way in terms of UBO requirements. And it seems that, you know, it's kind of a joke, but every other month there's a new requirement for UBO stuff. And that's throughout the EU. In the Middle East, for example, they passed Cabinet Resolution 58 in 2020, which introduced a new requirement for companies licensed in the UAE to maintain a register of its beneficial owners, shareholders, and nominee board members. Both direct and indirect ownership control should be considered for these companies. Countries such as Israel, Bahrain, Qatar, they have their own UBO register and reporting requirements. So the UAE is a little bit different than those countries. Countries like Lebanon, they don't have a UBO register, but they require UBO information to be disclosed to the corporate registry. Africa, they're kind of still in terms of corporate and corporate governance. Some countries have their own UBO register, some don't. So, you know, time will tell what that's going to look like in terms of countries that are catching up in terms of the UBO reporting.
Thank you, Daniel. And like I said at the beginning, Athennian has prepared a benefit ownership regulation guidebook. This is not only for the EMEA region, but global. And this is where we've shared some information on the nuances for the different jurisdictions, whether they have a registry, whether this registry is public or not, or if they're just reporting requirements for UBO. So we're going to share that with everyone in an email after the webinar. And Daniel, for upcoming legislations, for some of the directives and things to highlight in the different regions, can you share some of these information for Europe, for example?
Sure. So one of the newest ones, as of July 25th, so just about a month ago, it's in the EU, the Corporate Sustainability Due Diligence Directive, or CSDDD, CSDDD. So you might see it written out a few different ways. This requires large companies to identify and address the negative environmental and human rights impacts of their operations and supply chains. The CSDDD aims to establish a uniform standard for responsible business practices across the EU, and this will apply to all EU and non-EU companies. So a branch office, for example. All EU member states have 2 years from July 25th to incorporate these directives into their policies and operations. So that's a big one in Europe right now. And
Yes.
then,
Oh, sorry.
no, Rosie, if you want to go into the Artificial Intelligence Act.
Yes, and before we get there, I just wanted to do a quick comment on how to differentiate and how this European Union legislation works. So we have the directives and we have the act, like the new European Artificial Intelligence Act. So directives set goals that all European Union member states must achieve, but it allows each country to adapt it, to decide how to implement it, through their own national laws, resulting in some jurisdictions and some variations across the regions. But an act or a regulation, like not only this new Artificial Intelligence Act, but also the General Data Protection Regulation, these are mandatory to all member states. And that's the case of this new AI Act that became into force August 1st of this year, with full adoption expected to be by 2026. And this is very similar to the GDPR, meaning that it extends beyond European borders. It impacts any organization that develops AI systems that are used in the European region. Now that we know for this first rollout is that it categorizes AI systems based on risk levels and establishes specific obligations for developers, deployers. And right now, it impacts only what they have identified as critical sectors. So any AI that is developed or used for healthcare, for finance, transportation even need to adhere to rigorous requirements for risk management, data quality, transparency, and human oversight. And the sanctions are pretty high for not compliance. The fines range from 7.5 million euros or 1.5% of global turnover to up to 35 million euros or 7% of global turnover. And it depends on the nature of the infringement, of course, the company size, but the size of these fines show how seriously the European Union is taking artificial intelligence compliance, and it emphasizes the strong commitment they have to ensure the ethical and responsible use of these AI technologies. So let's go to the Middle East, Daniel.
Sure. And one of their leading, I'm going to focus more on Saudi Arabia right now. And Rosy mentioned it before about Vision 2030. And this initiative aims to diversify the economy and attract foreign investment through improved corporate governance regulations. This framework is designed to reduce the country's dependence on oil, as Rosy had mentioned earlier, and diversify its economy and develop public service sectors such as health, education, infrastructure, recreation, and tourism. As the name suggests, their goal is to do this by 2030 and look to expand on that afterwards. In essence of time, I'm just going to run through the other upcoming legislation. So the other one in Saudi Arabia is called the New Companies Law, and this replaces the Companies Law of 2015 and the Professional Companies Law of 2019. And this is one single comprehensive law which governed all forms of entities in Saudi Arabia. This introduced a number of significant changes together with a requirement for all existing Saudi Arabian companies to review and amend their articles of association to conform to the provisions of the new companies law and the filing format required by the registry there. And the last one for Saudi Arabia is the CGR, corporate governance regulations. The Capital Market Authority issued the CGR in 2017, which applies to all companies listed on the Saudi Stock Exchange. And this includes requirements for gender diversity, audits, nomination committees, and at least 3 independent directors on the board. And I'll get into in Africa in a second. So Rosy, anything?
Yeah, just a quick comment on this new corporate tax law in UAE. It imposes a 9% tax on businesses with taxable profits of around $100,000, $100,000. And this is exactly what marks a significant shift in the UAE's approach, moving away from its traditional reliance on revenue coming from office space rental, free zone incentives, but now they are creating these new for corporations.
Sure.
Yeah, from Africa. Can you tell us
Sure.
about Uganda? I know you've learned about these recently.
Sure. So last week, I actually met with the director for the Ugandan corporate registry, and she was very excited about their transition to digitize records. So this is to encourage more business registrations, but make the ease of annual filings and the corporate governance filings that need to be completed in Uganda makes it easier. So they're very excited about that. They do have digitization now. But in the next few months into early 2025, they expect to be fully digital, which my understanding is that it'll ease the ability to process filings in Uganda.
And also in Kenya, this makes sense because they're positioning themselves as this technology hub. They were one of the countries in Africa to adopt early the GDPR from EU. And for next year, they are working on some amendments to their own Data Protection Act to make, of course, the sharing and the protection of data easier, so to attract more companies to work in the country. And lastly, I just want to walk you through some best practices to navigate all these regulatory changes. Of course, here at Athennian, we recommend to leverage technology like Athennian. We have a product for global entity management that allows you to have a single source of truth for all the information related to the entities across all regions, including EMEA. We are GDPR compliant. Our software helps streamline compliance, create access groups, for example, so you can have an access group just for your companies in Europe, Africa, or Middle East, create different roles and permissions so you protect the information that's there. And Athennian recently came up with great artificial intelligence data capabilities to help streamline and automate processes like data entry, create entities, etc. So that's something, of course, that we recommend. Use technology to support the managing of global subsidiaries. And of course, Daniel, you also have a great advice for everyone here on how to leverage service providers like IBCF.
Sure. So in terms of corporate governance, so everything from entity registrations, corporate compliance filing, corporate governance matters. From a service provider standpoint, the key things are make sure there's clear roles and responsibilities of what the service provider is going to be doing, what the staff is responsible for, making sure data is shared correctly between the two. The next one is punctuality, right? Timeliness I should have put timeliness of communication and filings, but make sure communication flows in a timely manner, and those filings are submitted well in advance of due dates to avoid anything that could go wrong. And proper record keeping. So from 1 year to the next, whether it's information that needs to be on file with the registry or directives that you need to be aligned with, make sure that everything is kept, your records are kept in a neat, proper format. And that's really what all I have.
Great. So now let's go to our Q&A section. Please feel free to ask questions. We have a few minutes that we can take to answer these questions.
Sure. So I do see one in here now. So the question is the complexity of doing business in a country always linked to higher operational costs? So the costs are going to vary country to country, structure to structure, and there's going to be so many other varying factors, especially in this region. You know, what your share capital is, how many shareholders you have, you know, and again, just there's so many varying factors that can affect price. So, yeah, I wouldn't, you know, look too much into cost of filings or services because it's going to vary, but on so many different factors, and it has nothing to do really with the operational costs. Just more of other factors like the amount of shareholders, structure, country, things like that.
And I have a question here. Is Athenian tailored to the EMEA region? So the good thing about Athenian is that it has a flexible design that allows support for global entity management, not only for the EMEA region, but for any region. It has features that, for example, you can create templates that are specific for the region. It has global entity types for most jurisdictions, so you will be able to find all these different entity types that Daniel mentioned during his presentation are part of the different types of entities that are supported by Athenian. It has a multi-jurisdictional compliance tracking that you can create with different tasks that you can tailor to the specific country requirements. Again, customizable document templates. So again, that's the good thing about Athenian, that you can use it not only to manage entities in the EMEA region, but to manage entities globally.
Okay, so there is a question. Can we quickly touch on any new changes that may be coming to the Iberian region? So Rosy, do you have any thoughts on that?
Not really. So this will be Spain, Portugal. I know recently they have been very prone to have flexibility around labor laws to attract, for example, digital nomads. This has also been a little bit controversial because this is also impacting local economy, like the price of rent, the prices of different goods and services in the region. So I know they are looking into how to regulate this. I don't know exactly how they're going to tackle it. I know some specific cities and regions are taking some measurements on their own, and local authorities as well. There have been a lot of protests, for example, in cities in like Barcelona or other smaller towns, just to try to reduce not only the amount of tourism, but also especially the amount of people that are moving to the country because of the flexibility of legislation around digital nomads and visas for people to work in the countries for long periods of time. So I'm not sure if you're referring to that, but I know that's a very well-known trend in legislation that we will see in the Iberian region for sure. And I think that was our last question. I just wanted to invite everyone to follow Athenian and IBCF on LinkedIn. Thank you, everyone, for joining us today. There was a lot of information to cover. I hope this gives you some light on the different nuances and differences in the region. Like Daniel said at the beginning, this is a vast territory to cover. So if you have any closing remarks, Daniel, that you want to share with everyone.
I just want to say thank you for the opportunity to speak about this, and again, I hope everyone can take at least one thing away from this presentation. And again, it is a very large region that we covered, more than probably a third of the world. So, and we're always here as resources for questions and anything that may come up. So please feel free to contact us, and we'll help you with corporate governance throughout these regions.
Thank you, Daniel. And please, everyone, please look into your inbox in the next few hours for an email with a link to the recording of this webinar, and also a link to our beneficial ownership guidebook. Thank you everyone for joining us today.
Thank you all.
Bye, Daniel. Thank you.
Bye-bye.